The market is pricing in 80 basis points of rate cuts by the end of this year. And that's what you hear from the Atlanta Fed president. How do you kind of marry the views?
The market is way over its ski tips. So when I hear Raphael Bostic talking about not cutting until well into 2024, we differ slightly from that. I think probably the early part of 2024 is more likely, but certainly relative to market pricing, I mean, the market is saying that the Fed might be cutting as soon as next month. And as you said, that there's 80 basis points in by the end of the year, 300 basis points by the end of next year. That's really aggressive. And I think in order to see that, you have to see some kind of deep recession of the kind that I don't see many people anticipating at this point in time. So I think the market's perhaps got this one wrong.
But do you think that perhaps it's the bond traders who are foreseeing through other indicators that they're looking at that there could be a credit risk event? Because that would be the wisdom in that.
Right, so if you're going to do that, then that's perfectly possible. If you have some kind of credit event, then the Fed has to reverse course quite aggressively. But in that case, the equity market is massively overvalued. So you can choose which god you want to pray to, but you can't, I don't think, reconcile equity markets and fixed income markets right now. Our view would be that the US is perhaps heading for a relatively short, shallow recession, not of the credit event type that you were talking about, and in that case you will see some disinflationary pressure which will do some of the work for the Fed, and that's why I think that the Fed will be cutting in the early part of next year rather than the middle part that Bostic was talking about. But to get to some kind of validation of current market pricing does require a really extreme scenario, and then equities would be vulnerable. Our view is that equities are more aligned to reality right now rather than current fixed income pricing.
Okay, so then the follow-up question is, and I just lost my train of thought, but I guess the follow-up question essentially is, how realistically are you worried about a credit event?
So I think it would be naive and dismissive to say that we're completely sanguine about it. But in terms of the underlying fundamentals, we don't in any way see this as being a replication or the nascent foothills of something of the kind that we saw in 07, 08. But that's very different from saying it has no impact on the real economy. We are seeing a tightening of credit standards. We are seeing demand for credit go down. We are seeing an increase in the spreads of lending to the real economy. So we are going to see, I think, an impact on the real economy, even if we don't have some kind of credit event.
But with the regional banks, one thing has been made very clear, that the authorities are ready with their backstop plans, right? They're ready to backstop anything that may spiral out of control. And so to that extent, do you not think that the market would be mispricing, if at all, the risk of a big blow-up anywhere?
So let me be very clear. We don't think there's going to be anything of that kind. So you can slice and dice the market whichever way you want, whether it's looking at bank prices, stock prices, credit prices, Fed futures. If the market is anticipating any kind of event like that, then we would fundamentally disagree.